Edutrainment Workshops, the insurance industry's leading education and training platform, presents Life Insurance, the entry-level series, the products, the underwriting, and the planning applications to position your practice as the premier provider of insurance products in your community. Get on board, get on track, get to where you're going. And now, your Edutrainer, national insurance columnist, Steve Savant.
Well, welcome everyone. I'm Steve Savant, your Edutrainer and coach. For our Edutrainment Workshops, our entry level into life insurance. And all this week we're doing our introduction into current assumption universal life. And we've been using just all kinds of ideas and concepts from our great sponsor, Lincoln Benefit Life, an Allstate company, using their software program called the Eclipse Illustration Software. All this week, if you want to watch this, I say stop the tape, stop tape, that's how old I am. Stop the show and just go ahead and go out and download it by www.lblsales.com/ETW. As soon as you come to the site, you'll see this line, Run Installer, Eclipse Illustration Software Installer. It'll put it on your system and you can go page by page with us. We have found out that this is an excellent way to actually go through the tutorial with us, page by page. Your learning curve will actually accelerate. So hop out on their site, www.lblsales.com/ETW, and just download it. And while you're out there on their browser, go out to their additional site, which is playing at the bottom of our screen. It's kind of long, and if you say, Steve, I can't even see it there, either pause your screen or go out to the accompanying search engine optimization description page. I have it inside that page as well. You can just copy and paste and put it in there as well. And when you come out to this site, you'll see a lot of support marketing material that Lincoln Benefit uses. One of those I really like, called the Facts of Life booklet. It's a great data collection for your client, a good piece to hand out to people for a prospecting tool. It also comes not only in book form, but it also comes in electronic transfer form. You can just attach email and send it. And it also has prospecting letters and postcards. Really good entry level to use for life insurance marketing. And again, they are already approved by Allstate, but if you're using somebody else, as far as your broker dealer or whatever, and you have to submit your kind of communication like this, then please make sure that they see this first before moving forward and using it with a client. And also, many people say, wow, I missed some of your shows. Well, some of our actual networks where this is being distributed are easy to see, and you can go back to the former show, but if you say, I can't find that, or I didn't get it from that site, you can always go to our homepage, www.brokersalliance.com, and as soon as you come online, just hit our on-demand videos, you'll hit our archive, and you can go through all our back shows, which I recommend. If you're just starting now and you say, boy, I need to go through this, start at the beginning. So when you go out there, www.brokersalliance.com just brokersalliance.com. Now, if you want to order the life manual, the vocabulary that goes with it, or any of the docs that you see us use on the show, please feel free to just write me, thebiz@brokersalliance.com. That's the biz, THEBIZ at brokersalliance.com, and we'll just go ahead and send it to you. So now we're going to go back out. We're going to come online with our software that we're using. And yesterday's show, I kind of bypassed this because I want to kind of spend a little time on this, and I might spend more time on it tomorrow on the whiteboard just to make sure we're all really clear on this. And so I'm looking at this. It says, how are withdrawals taxed? Now, generally, some of the language that's being used by a vast majority of our illustrations when you get a proposal in front of your hand is very legalese. I find their treatment of this really easy to understand. I wouldn't say it's totally consumer perfect, but boy, it is really close. Really good communication skill sets went into this. Somebody actually wrote this out, and we're talking about how are withdrawals. So if my client wants to take withdrawals of their original basis, how is that going to be taxed? And I think it's worth our talk or our read today to kind of go over this because it's really important, especially if you start using life insurance as a tax-advantaged supplemental income alternative. It's excellent. Withdrawals from a life insurance policy are generally taxed as ordinary income to the extent that the withdrawals exceed the investment in the policy, or basis. In some situations, withdrawals during the first 15 years may result in a taxable event, And you have to be careful because to recover the investment of the policy, if you take it out during that 15 years, it may actually be, with gain, may be subject to ordinary income tax. So just a heads up. If the policy is a modified endowment contract, of course, withdrawals are treated as a taxable distribution to the extent of policy gain. Withdrawals are treated first as distributions of policy gain subject to ordinary income taxation and may be subject to an additional 10% federal tax penalty if made before 59.5. That's a huge caveat, and so you'll want to make sure, if you're saying, I'm not unsure of myself, you can always come back to the carrier and say, could you make sure that I'm doing this correct, that I'm not exposing my client to any of these taxable events? They may come back to you and say, that's okay, here's what we see. You may want to show it to their CPA, their tax attorney, whoever their fiduciary is, and get tax advice before you move forward. Now, on loans, totally a little bit different here. How are loans taxed? Well, hopefully, they're not taxed at all. Policy loans from a life insurance contract are generally not taxable if taken from a life insurance policy that's a non-modified endowment contract. Now, we talked about this about a month ago in our first classes introducing you to this idea. A non-modified endowment contract, if the policy is kept in force for the life of the insured, you will be able to take out, you should be able to take out policy loans of gain, and that policy loan of gain should not be a taxable event. So it's not going to show up on your 1040 because you're actually taking a loan of cash values from your contract. Remember, heads up, there are a variety of ways of accessing loans. Not every loan provision on those contracts are guaranteed. So you have to say, is it current company practice or is it contractually guaranteed? If I do illustrate it, is it zero net cost loans, wash loans, spread loans, direct recognition loans in whole life, as in whole life, or arbitrage, or they call it participating loans with index UL. You'll want to really look at all the possible options so that you can find out, is it current company practice or is it contractually guaranteed? Hey, is it fixed or is it variable tied to some other market indice? You'll want to always look at some of this to say which one is it and look at that. But how is the tax treatment? It shouldn't be, as long as it's a non-MEC, the contract's held for the life of the insured. However, when a policy is surrendered and the net surrender values are used to pay back the loan, the transaction is treated like a withdrawal and will be taxed ordinary income tax accordingly. If it's a policy's a MEC, the loans are treated as a taxable distribution to the extent of the policy gain. So loans are treated first as distribution of policy gain, subject to ordinary income tax, and maybe to an additional 10% federal tax if you take it out before 59.5. Again, you got to make sure, and that's why we usually teach this, non-modified endowment, so that you don't have to walk through this. This is a lot of jargon to remember, I know. Now I want to go up the page here, and we've talked about some of these things. Oh, let me get back here. Now, we talk about the annual premium and the premium outlay, the total premium outlay. How much? What's the leverage? When I look at leverage, I want to know, how much did I pay? How much death benefit did I get? Was that leverage 2 to 1? Was that leverage 3 to 1? Was that leverage 4 to 1? Second to die, sometimes it can be 5 to 1. And if they're younger and they both are very healthy, it might even be 6 to 1 leverage. And when I'm talking about that, I'm using the word total premium outlay versus the death benefit that I have. And then I'm looking at the non-guaranteed elements. And remember, earlier in the week, we showed that difference between, here's the current ledger and here's the non-guaranteed current ledger. So your current ledger, which is non-guaranteed, and your guarantees. Current assumptions. What are the current assumptions with your cost of insurance and the interest rate that they're crediting it to? And then midpoint assumptions. Some carriers like to do this. This is part of our model now with the NAIC. We want to be able to show the current company practice, the guarantees, but a midpoint assumption too. So if I'm showing 6% in my current assumption UL, although probably nobody's doing that right now, it's probably the top out rate, maybe be 5.475 on current assumption. So you may want to show a 4.75 or a 5% current assumption, then a 4% midpoint, and then a low bottom line for interest rate might be 3%. You want to test under certain conditions. How will this perform? Now, we've been at the floor. We've been in a low interest rate environment for a long time. So showing that midpoint assumption will really say, hey, what could happen if it actually drops another 100, 150 basis points? So having your current company practice, picking out a midpoint assumption and your guarantees will kind of give the client a good idea what to look forward to. And look at when you spread this apart, you're looking at 5, 10, 15, 20, 25, and out to endowment policy years. These are snapshots. You're looking at policy accumulation, total premium outlay. I'm looking at the guaranteed values. And remember, in the first 5, actually in this case, the first 10 years, there's a difference between total cash value and surrender value. So you want to keep that in mind. So if my total premium outlay over the next 20 years is $50,000 and my net surrender value on the guaranteed is $22,000, my midpoint, the lower one that I picked off the current, is $39,000 and my current one is $54,000. I want to look at all three. Legitimate numbers. Here's my 54 of current interest rates that are being credited to the policy, stay online. Here's a lower, maybe 150 basis points lower, and here's the guarantees. This is a nice snapshot to kind of give a tale of two cities and a basic down the middle idea what I think it might be using midpoint non-guaranteed assumptions. Now, this is the physical illustration, and most of us have seen these before, and so I don't want to bore you too much with this. I'm just going to touch on it a little bit. But it shows the client, this is the annual outlay. This is the policy year versus the age of the client. Usually, these illustrations are showing end of year values. There are a few people, few carriers in using whole life that may credit the additional dividend for the second year, once the second year premium is paid, and give it direct recognition. But for most sake, everything we're talking about is at end of year. So in this case, I'm in year 5, I'm now 50, I've been in the policy, I've shelled out $2,505 a premium for that 5-year period. Those are and I haven't had any distributions, withdrawals, or policy loans at all. And I notice that my policy values, they're now starting to go up. I see my net surrender value. See, the surrender values come online, so I can't get to any of this money anyways because my surrender are online. Let me get down to my guaranteed values. So there are no guaranteed values because the surrender charges are covering this. And when I go over to the non-guaranteed video, the current company practice, you'll see again, the numbers are higher because I'm using the current company practice, whatever the crediting rate is. However, my surrender charges are still coming online for those first years, so I'm not going to have really access to any of this money. If a client has liquidity issues and they don't see this as a long haul commitment, you should not be selling this because the surrender charges are there to protect the company's ability against disintermediation on interest rates, and they have to put something in here to protect it. Contracts that show early liquidity are okay. Generally, their cost of insurance later on is a lot higher than current assumptions. So if it's early cash value you're looking for, they may be all right. But when I'm looking at this, I just want to make sure the client understands I can't have you having 36-month, in this case, 3 years, 36-month remorse because there's going to be surrender charges for this. Now, I might be looking at this in a different setting. I might be looking at this at age 65. And so I look over here and I say, wow, I've accumulated $54,000 and there's no surrender charges now, as you can see. Remember, we're at our column here, surrender charges. So now I'm at age 65 and I have $54,000 because the surrender charges are gone. I can do what I want with that. Withdrawals to basis, policy loans to gain, all those things I can access to. But let's say the market didn't do as good as I thought. Well, here's our midterm at age 65, using this as a supplemental retirement number. Now I'm at $22,550. So I just want to keep looking at, I'm sorry, that's the guaranteed column, I think. Let me see. Yeah, the guaranteed values. My midterm point would be somewhere in between this one. So when I'm looking at illustrations, I'm kind of giving the difference between the current company practice, a bookend quote on that side, and the guarantees, a bookend quote on that side, and my midterm numbers coming in between. And then showing it going all the way out. If I paid it all the way out, I could be at age 121, the maturity date of this contract, and I'd be at 76th policy year, not the age. My age is 121 and the maturity date, and I would have, sometimes contracts do not charge past age 100 or past their endowment, or well, for sure not past their endowment, but past age 100, so there may only be a policy fee. It depends upon each carrier. They may stop charging COIs at age 100. It just depends upon the contract. You'll have to review each policy to make sure you're getting what you want. But there are the numbers based on current assumption all the way out to the maturity date of 121, the endowment date of this contract.
This has been an Edutrainment Workshop, the educational division of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, and sponsored by Lincoln Benefit Life, an Allstate company.